Morning folks, quick update on natural gas. Natural Gas World reports that Freeport LNG gas consumption is running near zero for the fifth day in a row, and that's important because those exports are not going out. Reuters reported yesterday that Freeport LNG's liquefaction plant remains mostly offline for a fifth straight day, with gas utilization rates at 125 million cubic feet per day, or 5% of its fully operational use. Freeport LNG has been the second largest LNG exporter with an installed capacity of 15 million tons per annum, but mechanical problems and repairs to its Quintana, Texas plant contributed to reduced US LNG output in February and March, the data show. So that's somewhat bearish for natural gas. And of course you know this already because you watch these numbers. US drillers cut oil and gas rigs for fourth week in a row on Baker Hughes count. US energy firms this week cut the number of oil and natural gas rigs operating for a fourth week in a row for the first time since September 2023. Right, so all of that out of the way, and it's not great news in general, and seasonally we're not quite there yet, but let's have a look at the charts. So this is the 4-hour chart of the current front month contract. We're right at support. The only thing that happened yesterday was two dark 4-hour candles, two bearish candles, and then four sideways, I suppose, since then. We're at the bottom of this megaphone pattern, although we've pierced through it, and we're also at the swing low support. Let's zoom out a wee bit and see how this looks. So there you can see at the bottom of this blue block, the 61.8% Fibonacci, which we tried to hold for a couple of days. We broke down yesterday, and here's the 78.6% Fibonacci at 1.64. I think today we'll probably get a spike down into that 1.64 level, followed by a wick low type reversal candle, so we could spike down into that level and back up again, 1.64, or something like a piercing pattern or something like that. So keep your eyes peeled for a 4-hour candle reversal pattern. If we don't manage to hold 1.64 or 1.65, of course we've got 1.5 below us, this recent swing low, not quite 1.5, just around there. And below that we've got further support just below 1.5 and then even closer to 1.4. So I'm long on natural gas. My average entry price is 1.73, so we're just a little bit out of the money on that. And I have a 65% position on this at the moment. Let's have a look at the day chart. So here's the Henry Hub natural gas futures price provided by the NYMEX, and let's just zoom into this one a little bit. Notice first of all that we're at the top of this gap. Now the top and the bottom of gaps often form resistance or support. If we were to get to the bottom of this gap, and bear in mind it's a rollover gap, not a real price gap, that would take us to about 1.66 or 1.65. That seems to coincide with the 78.6 Fibonacci that we saw on the other chart. So let's draw that in on this chart. I'm going to draw it from this swing low to the top. And there you can see the 78.6% Fibonacci retracement level coincides with the bottom of the gap. The scenario that I showed you on the 4-hour chart with a spike low or a piercing pattern would mean on the day chart we'd get down to the 786% Fibonacci level and then bounce up from there. And hopefully actually we'll form a daily reversal candle at the same time. If that doesn't happen today, then watch for that a little bit later on this week. But we really want to see the 20 and the 50 period moving averages on this day chart defeated. That's at around 1.76. If we can close above 1.76 or 1.77, where these moving averages are, we should be set for a move up to $2, $2.15 or $2.20, and then $2.35 or $2.40. Let's leave this video on the 4-hour chart. There we are, just trying to form a base right now. Remember, we could spike down to that 786 at 1.65. If you found this video useful, a like, share, and subscribe would be gassy. Thanks so much. Take care.